Welcome to the recorded version of Planning for the Costs of Aging from April 19th, 2016, brought to you by the American Society on Aging and a generous sponsorship from the National Reverse Mortgage Lenders Association.
Slides from there. If you want to send in your questions, you can send in your questions at any time, but we are going to be waiting till the last 15 minutes of the hour to do the questions all at the same time, so just a little note on that. If you want to claim CEUs for today's webinar, you'll be receiving a follow-up email by the end of the business day today that's going to direct you to the online CEU application. So watch out for that coming your way by the end of the business day today. That's going to contain also a link to the slides for today's webinar. So those are going to be sent to you after the event as well. Speaking of CEUs, if you are not logged in directly, that is if you are participating as part of a group, or perhaps you have just called in on the phone, we cannot track your electronic attendance and you would not be eligible for CEUs. So we do need to track your electronic attendance. So please go back to your workstation and log in using the confirmation email that you would have received after registering. There's still plenty of time to do that. Please note that you have 30 days for which to claim CEUs for today's event. And please note that it can take 30 days from the date of your submission in order for us to issue your CEUs to you. We really want to thank the National Reverse Mortgage Lenders Association for sponsoring today's webinar. We do appreciate them putting on today's event, and we do want to thank them for presenting today's webinar, Planning for the Costs of Aging. All right, we're going to have a couple different presenters here today. Jenny Werwa is the Director of Public Relations for the National Reverse Mortgage Lenders Association. She joined NRMLA in May 2015 from the National Association of Realtors, where she led all media outreach related to NAR's legislative and regulatory priorities. Jenny also has communications and outreach experience from Capitol Hill, the American Immigration Lawyers Association, the American College of OBGYNs, and Physicians for Social Responsibility, a nonprofit in Washington, D.C. She has a BA in Government and Politics from the University of Maryland College Park and an MA in Public Policy from George Washington University. Barbara Howard is a nationally recognized speaker and educator, now providing gerontological consultation services to for-profit and not-for-profit organizations. She was a Director of Education at MetLife Bank Reserve Mortgage Division in Westport, Connecticut, responsible for the department that oversees the education, training, and consultation services for internal and external audiences on aging, retirement, and retirement funding issues. Prior to joining MetLife Bank, Barbara worked as the Director of Gerontology for the MetLife Mature Market Institute, where she provided training and education and contextualized the Institute's studies and polls. Jamie Hopkins is an Associate Professor of Taxation at the American College in the Retirement Income Program and co-director of the New York Life Center for Retirement Income. He also holds the Larry R. Pike Chair in Insurance and Investments at the American College. Our fourth presenter is going to be Dan Hultquist. Dan is a certified reverse mortgage professional and is the co-chair of NRMLA's Education Committee. He's the author of the book Understanding Reverse, which answers the top questions he has received as a national reverse mortgage trainer. And with that, I would really like to welcome our presenters for being here today. We want to thank you for taking time out of your day to present with us, and I really appreciate you being here. Thank you for being here, Jenny, Barbara, Jamie, and Dan.
Well, thank you so much, Steve, and thank you all for joining today's presentation sponsored by the National Reverse Mortgage Lenders Association. NRMLA is the industry association for reverse mortgage professionals, ranging from loan originators to mortgage counselors to servicers and issuers, all of whom must adhere to our strict code of ethics and professionalism. We serve as an educational resource for our members, consumers, and also professionals like you who all work with the senior population. And this is why, for the first time ever, we've launched Reverse Mortgage Education Week. This week, in addition to partnering with the American Society on Aging to present Planning for the Cost of Aging, NRMLA joined with the Mortgage Bankers Association yesterday and will join with the National Association of Realtors on Thursday to present informational sessions to their members and affiliates. We're also hosting a special webinar this Friday at 3 p.m. Eastern to provide all interested professionals with information about strategic uses of home equity in retirement funding. Today's session, Planning for the Cost of Aging, will feature 3 sections. Gerontologist and former ASA board member Barbara Howard is going to present on the expected and unexpected costs of aging. leading retirement income planning expert Jamie Hopkins will discuss strategic uses for home equity in retirement planning, and Dan Hultquist, who you heard is the author of Understanding Reverse and who NRMLA is very lucky to have as our co-chair of our education committee, will provide an overview of reverse mortgages, the changing face of borrowers, and new consumer safeguards that protect borrowers and their spouses. And now I'm pleased to turn the presentation over to Barbara Howard. Barbara?
Thank you so much, Jenny. It's really good to be back here with ASA, and I'm looking forward to spending some time with people today. So, again, thanks for being here. We all try to make a budget and then live within our means, right? Sometimes we do that more successfully than others, and there are plenty of months where I feel there is too much month at the end of the money. But while we're working, sometimes unexpected expenses, although difficult to manage, can be handled a little bit better and are not as profound as they may be when we no longer have this paycheck coming in. So we're going to go into some of these expenses today, and then afterwards my colleagues are going to offer some new and innovative solutions so many of us won't have to make major lifestyle adjustments as we get older. Maybe the next slide, please. I don't know why it's not working. Sorry. So this is a pretty new infographic that just was released by our friends at NCOA. And as the graph tells us, in the space of a generation, we've really improved our life expectancy, and for the most part, these additional years have come in good health. So what are the implications of a longer lifespan? If we knew what our expiration date was going to be, financial planning would be a simple assumption. But not knowing that expiration date makes budgeting to make our money last a lifetime pretty difficult. Today we have to have more money saved or built up or coming in to make sure that we will not run out of money before we run out of years. So while many of us are healthy, as this graph shows, not all of our years are going to be healthy. And these healthcare costs can be staggering, and I'll discuss some of those in a second. First, in the next slide, let's take a look at what we consider to be expected and unexpected expenses. So as with anyone, we have items, that we know we're going to spend money on. We have food, housing, and typically some kind of health care expenses, whether it's health insurance premiums or co-pays, normal stuff. But, are we budgeting for the unexpected health care expenses? What if there's a major change in health status? What if, you developed a disability or a chronic condition or even multiple chronic conditions? Have you budgeted for that? Maybe because of these changes in conditions, we need to make home modifications, which would allow us to stay in the home of our choice. Do we need to make sure there's a bathroom on the first floor? Do we have to move the laundry up from the basement? Do we need ramps? All of those items. Now, I just talked about longer life expectancy in retirement. We're spending all these years in retirement. Have you thought of the fact that you might need to buy a new car while you're in retirement? Is that in your budget? What if you need a new roof on your home, or you need to replace the windows or the furnace, or a multitude of things around the home? So, again, we have to plan and budget for these. Now let's take, in the next slide, we'll take a look at what average incomes are, and then we'll look at where the money goes. So not surprisingly, incomes start to fall off around age 65, as we see the number of people in the paid workforce going down. Again, many people are working longer and longer, but we do start to see these go down. Now, these data are through 2014 from the Bureau of Labor Statistics. What is interesting in this data we see is the percentage of home ownership, which is pretty high and quite stable through this time period. Housing wealth, and then how to use it, is going to be addressed by my colleagues in a couple of minutes. Okay, on the next slide, we'll look at where does the money go. So across the age spans, we see that housing was the greatest expense in dollar terms and as a share of annual expenditures. What is interesting, though, is that among older homeowners, almost 60% are mortgage-free. Those without mortgage debt was about 44% in the 55 to 64 age group, and over 80% for the over 75 group, which leads us to talk about this as an untapped resource to assist people. The share of a household budget that goes towards health care starts to increase as we get older, as these data show you. Again, we have two things competing here: incomes going down and expenses going up. So I've mentioned health care a few times, so let's take a closer look at health care and more specifically long-term services and supports. Next slide. Fidelity Investments has done some research on this, and they're estimating that couples who retire at age 65 will spend $245,000 on their health care expenses during their retirement. And these would be items such as deductibles, co-pays, health insurance premiums, and things not covered by health insurance. And the Employee Benefits Research Institute has a more conservative estimate, saying you should save almost $400,000 for health care by the time you're 65 to have a 90% chance of having enough money. Now, as many of us know from either our work or even our own personal family experiences, long-term services and supports are mostly not covered by insurance. And those expenses are absolutely staggering. And if you fail to plan for those, you have planned to fail. So, again, my colleagues are going to offer some solutions, but first let's look at how expensive some of these items might be in the next slide. Genworth surveys long-term care services and supports year after year, and this is their 2015 cost of care survey. And the expenses keep increasing, and they are kind of mind-numbing. Even expenses, even community-based care, whether it's home care or adult day services, can mount up pretty quickly when you're talking about a multitude of years of this kind of care. And this will absolutely erode retirement savings very quickly. So now what I'd like to do is to turn it over to my colleague, Jamie Hopkins, who's going to begin to offer some innovative solutions for some of these expected and unexpected expenses.
Barbara, thank you so much for that. It was very fantastic and gave us a great set kind of on, all the costs and where we need to be. So I want to get started, and I'm going to do a little bit different than what Barbara just did, but same basic concept. I'm going to present here on, kind of what is retirement income planning, how are we going to finance the costs and health care issues when dealing with a senior who might be on fixed income, that might not have an unlimited number of income resources, opportunities, so we have to be a little bit more strategic. And so, again, this very beginning is just kind of what is retirement income planning. And so what I want to talk about, and I use an analogy here to address what I think retirement income planning is, and I talk about it like shooting a moving target in the wind. And so what's the target? Well, the target is really meeting the client's goals. Now, that target's going to change over time. Their goals might change. Their expenses, as Barbara said, might change over time. We've got unexpected ones. The length of time that we're going to be alive for, so the kind of distance that target is away from us today, that's going to change. It's not going to be in the same place 20 years from now as it was today. That target's going to move. So it's a moving target. The other part, the wind, well, the wind is all the risks that we face in retirement. So longevity, long-term care, sequence of returns risk, public policy risk, health care risk. Those are going to change the manner, the path in which we can get from where we are today to our end retirement goals. Being able to be self-sustaining, sufficient, live in dignity in retirement. In order to be able to do those things, we are going to need to have a good plan in place, a plan that takes your needs, your risks, your assets, and puts all of that together. So, here's just kind of an expanded view of the risks. I kind of hit 4 of the main ones, but again, we have healthcare, frailty, elder abuse risk, market risk, interest rate risk, reemployment risk, loss of a spouse risk, unexpected financial responsibility risk. And that's a big one as we see more people kind of moving into homes. We see these, kind of what might have been a more traditional view of what the home looked like, where grandparents and grandkids and parents all live in the same community home. Well, we're seeing some of that again. And so who's financing that? Did we build that into our plan? Are we going to be able to continue living the lifestyle that we want in the home that we want, where we want to live, and actually kind of meet our needs? So the next part here, I want to spend just kind of a minute or two, and there's what I have up here is the first 5 of 10-step process. The next 5 show up on the next slide. And so you see here is retirement income planning process. And again, it really is a goal-based planning. That's what retirement income planning is. So we start with the client. It's client-focused, right? We don't take a cookie-cutter retirement income plan and throw it on top of somebody. It really does start with the client. So we take a look at them, and we say, client, where's your current situation? What do you want to do in retirement? Right, your goals, and prioritize them. How important is it for you to travel? How important is it for you to be able to pay for some of your grandkids' college? How important is it that you can keep your golf membership? How important is it that you meet your health care expenditures? How important is it that you get to stay in the home you're in today? There's a lot of things we need to ask there. And it can actually be challenging just for a client to even just vision what their retirement's going to be look like. And even setting aside, maybe what we say are our expected expenses, the ones that we're going to need to have, right, our required expenses versus our discretionary expenses, that can even be a big process and challenge. But we need to do that. It needs to start with that because we can't get a good plan in place unless we did a little bit of what Barbara just had us do too, which is say, what are our expenses and what are our goals here? What do we want to meet? And so that helps us get to our actual income needs. How much money are we going to need to make it through retirement? Especially if we want to fund all this ourselves. If we plan on relying on government programs, again, that'll come into the plan, but we'll build that a little bit differently. And so the next thing that we want to do is we want to start looking at sources of income. And that's what, kind of the meat of my little discussion here today will be on, or what are some, maybe non-traditional sources of income? How can we use home equity as a source of retirement income? And income in the sense that, maybe not taxable ordinary income, but income in the sense of income, money that can help us meet our retirement expenses and needs. How can we do that? And so we're going to want to identify those sources of incomes. At some point, we want to go through a calculation of what, do we need? How prepared are we? And, usually we're running some type of Monte Carlo analysis there to figure out how many different, based on historical data, how many times would this plan be successful? And for most people, right, in the United States, kind of our average retiree, they're going to struggle a bit in retirement. It's not going to be all smooth sailing. So we're going to need some flexibility. We're going to need the plan. We need to do better than we have done in the past with this. And so then if we have a shortfall, we don't have the income that we need in retirement, how do we go out and get that income? Can we reinvest? Can we reallocate? Can we keep working longer? Can we defer Social Security? Can we tap into home equity? Which of these strategies is going to improve our plan the most? And then as we move forward, once we start getting kind of the foundation of a plan in place, we're going to look at tax and legal issues that could come up, those things that could change our path. Some of the other risks that might show up too, whether it's long-term care, that's a tough one to plan for also. And then eventually we should now know, what's kind of the appropriate strategy for this individual, what meets their risks, their concerns, their risk tolerance, what they want in retirement, and then we put it all together. And so that's kind of, my general idea of what does a retirement income plan look like, and that's actually what we teach at the American College in our retirement professional designation, the RICP. We teach people to engage in comprehensive retirement income planning because it can be very beneficial. And right here, I love this research. David Blanchett from Morningstar did research that got published, and it's titled Alpha, Beta, and now Gamma. And so this went through and said, well, let's try to figure out what the value of advice is. Because we always talk about, oh, we know how much advice costs, there's the fees, and are there hidden fees, and a lot of this was wrapped up into the Department of Labor rules recently, the impact of fees. But what we don't spend nearly enough time trying to measure or figure out, assess, is the value associated with a good financial advice, with good retirement planning advice. And so what David Blanchett did was basically went through and said, hey, let's look at what happens if you move from just kind of the general average decision over to making a better decision. How much can you improve your retirement income by? And the reason I said I really love this is because this right here, what he says, you could basically increase your retirement income by 38% by just planning better, by making better decisions. This is without saving a single dollar more. 38% more, right? So if you're somebody who could generate $100,000 in retirement, which is pretty good, you can get $138,000 according to this research by just making better decisions. I think that's really important because it shows the value of advice, that we can really improve a situation by looking at, our options and making smarter, better, and more tailored to your situation decisions. And so then I have down here at the bottom, though, I said I love this, but what's missing? Well, what don't we have on there? Well, we've got Social Security. We've got a withdrawal strategy, right, a dynamic withdrawal strategy, trying to reduce sequence of returns risk on our portfolio withdrawal. Something about tax efficiency, so making sure that we're paying attention to tax rates and kind of tax brackets, doing all those good things. Making sure we're properly allocated between different assets, annuitizing a portion of our income, take away some of that risk. And one of the next big things there, when I said what's missing, well, home equity wasn't part of this. Making smart decisions about where to live, when to move, how to tap into home equity, that wasn't part of it. So really, I believe this could be a lot higher, right? A smart decision. You could probably rerun this if we put home equity under this umbrella, reran it. We could improve some of these other areas and actually move up, right, the total income that somebody's getting by making smarter decisions about home equity. And why is that the case? Well, I love this. This is, we had some other U.S. Census data. This one's, a little bit older now, not too old. We're still, just a handful of years away from it. But what this, and it hasn't changed too much, honestly, but what this does right here, it says, looking at the kind of average American, that median person, where's their wealth? And when we look at this, we say, well, they've got non-equity assets, and this is kind of at 65, married couple, what's kind of the average? Well, about almost $100,000, $92,000 in non-equity assets, and about $190,000 in the home. And so you look at that and you say, man, it's almost twice as much somebody moving into retirement is going to have. You're kind of looking again at our average person, that big medium, that big middle of the country, trying to help them. And they think, a lot of their wealth is in their home. And we know that, right? When you deal with senior clients, when you deal with clients, a lot of wealth goes into the home. Paying that mortgage helps put money aside. It helps save each and every month. And so it's an automated way to save. And, it's about, it's basically double what you would have as non-equity assets. So when you look at this, which one would you rather be making good decisions on? I guess 2/3 of the pie or 1/3 of the pie. And you look at it and you say, yeah, it's pretty simple. If I didn't know what those were, I'd say I'd rather make good decisions about the kind of left-hand side equity and home. And so then that leaves me, what can you do with your home, right? And people, because I say, well, home equity is an income source. And people, I say, yeah, but you need a place to live. That's true, right? You're going to need housing services, as I like to call that. You're going to need a place to live. You always need that. And so we don't want to say, oh, well, 100% of our home is some type of financial asset we can tap into. It's probably not, right? Because most likely, even if we sell our home, downsize, we're going to have to buy a new home or rent, or we're going to move into a care facility, or with our family, well, maybe in that case you can free up most of your home. But that's really not our default point, right? Rely on others to get you through retirement. That's not where we want to be. We want you to live in dignity and independently in retirement. So here's a list of some of the ones that we have. Aging in place, that's a big movement. People want to stay and age and live in place. Can we downsize? Can we sell our home, move somewhere else? Sale, leaseback, and I have a couple slides on these, so I'm not going to spend a lot of time on them right now, just giving you the overview. Sale, leaseback. Could we just relocate somewhere? Could we live with our family, which I said hopefully isn't our default? Are we just going to sell the house? Well, again, we have to move somewhere. Are we going to rent then? Are we going to go into a continued care retirement community, our CCRC? Can we engage in home sharing? Can we get a special purpose loan? Can we use some traditional line of credit or home equity loan? And what about reverse mortgages? Where do they fall into this whole discussion? And so I'm going to hit a little bit of each of these. So home sharing, and this is I want to say, this is most akin to, the Golden Girls situation. You got a bunch of people that move into one home, maybe 2, 3, even 4 people that could live in one home, share with the costs, and have companionship. And so that can actually be an income source for the homeowner. They can bring other people in, they pay rent, they reduce the expenses, and they get companionship. Now, we do see actually there are about 4 million people over age 50, women, that live in these type of arrangements in the United States. So it's actually a lot of people, according to an AARP study. And, again, mostly women, mostly senior women. There are now over 20 agencies, mostly nonprofits, in states that can help match people up if this is something they're interested in. So next one, probably our most traditional, at least in the thinking of what we might do with our home equity in retirement, is downsizing. That we live in the 5-bedroom house where we raise the kids, and now it's just 2 of us, and we downsize. We sell the house and move to a smaller home. And that can help free up cash. But when we actually look at why people move, actually the number one reason why people move is to move closer to family. It's not to free up cash or reduce expenses. Well, the next one actually is to reduce expenses with the home, so that's a good one. And then the other one is a change in health. And so if your health starts declining, a lot of times we're forced to moving. It's not so much a willing decision. Now, we see most people want to age in place and stay in their home as long as possible. We don't actually see a high percentage of retirees move from year to year. It's pretty stagnant. People are not moving each and every day. Now, again, when we downsize, we might free up some cash, but we still need a place to live. So we still need to figure out, do we want to rent? Do we want to engage in a CCRC, move to a retirement community? That's still a big decision. Now, sale, leaseback, a little bit different here. Now, I don't see these as commonly used. We talk about them in financial planning, but that's not that common. Now, what's the idea with the sale, leaseback? Well, you own your home, and you need income, right? You're starting to get a little cash strap month to month. And so what do? Well, instead of just selling your home, you say, I want to keep living here, and my kids have a lot of money, but I don't want a handout from them, right? And the parents say, no, don't give us any money. But they might be willing to sell the house to the kids because the parents might think that they really want the kids to have the house. They were going to leave it to them anyway. Kids get the house, which they're going to end up with anyway, and they give the parents basically the money for it. And so the parents now have freed up income, and they can rent it back. And actually, if you want that situation, right, then you can have all the tax benefits associated with a rental agreement. It has to be arm's length in that situation to actually get any benefits there. I have that Section 121 exclusion. More so, I just wanted to bring that up at some point. Very few people ever owe taxable income on the sale of their home because an individual has basically $250,000 and a couple $500,000 of gain as long as you use the home as your basic principal residence for 2 of the last 5 years. So very few people run into that. So nearing the end, got a couple more slides here, and then I'm going to turn it over. But HELOC, we've got this is kind of our home equity line of credit. Not a reverse mortgage, another way to tap into home equity. And the main takeaway I always want people to know about HELOCs or other forms of lines of credit, not reverse mortgages, if we have to pay them back, these typically in retirement, once we're living on fixed income, limited assets, these are usually better, according to research, used for short-term expenses, something 6 to 18 months, maybe 2 years. But once we start getting outside of that range, we're probably going to want to look at a different funding source. So this can be something, roof starts leaking, maybe your health, you're getting a little bit more frail, you want to update the house, redo a bathroom, get a chairlift in there. This might be able to help with that, and we can pay it back over 12 months or 18 months, and so we don't have a new outflow of cash for the next 30 years in retirement. We don't want that. Now, one of the downsides of kind of our HELOC, usually they're cancelable, right? They have a draw period, usually 10 years. After that, it ends. So it's not a permanent line of credit. Again, if we don't repay it, we run into the same issues of not repaying debts all over the place. House could go to foreclosure. We could lose the house, all of those things. And so, again, just paying attention to, do we want to engage in that type of transaction? Single-purpose loan is really a specific type of reverse mortgages that are out there to really, kind of help people with limited income, limited assets tap into their home equity for specific purposes, right? A single-purpose loan. And so I just pulled up one here to illustrate this one, which is really one out of Connecticut, the RAM, reverse annuity mortgage, which is there to help individuals 70 and over access their home equity to pay long-term care expenses. Now, depending on what state you're in, again, you have to go out and look and see what's available. There are income guidelines to qualify. There are minimal closing costs, somewhere right around $1,200 to $1,500. Interest rate, it does move. It's not fixed right now, but somewhere in that 4.5% to 5% from the last time I checked it. It could be a little bit up, a little bit down right now. So, again, you'd always have to check that. And here, when is this due? Well, it looks like a traditional reverse mortgage in some, or I should say our HECM reverse mortgages that, we don't always have to make payments. Heirs are not on the hook for any remaining debt. Some of those features are around. Some of them actually do require annual payments, so it might be a little bit different than a traditional reverse mortgage. Then we want to get there, and then I'm not going to be the one spending most time on reverse mortgages. We're going to pass that over to Dan here in 2 more slides, but I wanted to bring it up and say, how does it fit in? Reverse mortgages really do fit into retirement income plan. As we saw, the home is such an important part. We need to make good decisions. People want to stay and live in place. So one of the best options actually is a reverse mortgage, and how does it fit in? Well, it can fit in by helping us in a lot of different areas. Sometimes it's just cash flow. Maybe we have a mortgage and we want to turn that off and get income from our house instead of having an outflow of cash. Sometimes it might be to improve our systematic withdrawal strategy, which we saw in David Blanchett's research was one of the ways we can significantly improve our other retirement income. And so that's usually because of sequence of returns. And what is that? Well, that's when the market is down. We're invested in stocks, and 2008 comes around. I don't want to have to sell my stocks that year. It's down 30, 40%. So what's a better decision? When the market's down 40%, to withdraw from there and sell my assets at a 40% loss, or borrow from my home at 4%, 5%. Well, that's a no-brainer. That one's easy. And we know, we've seen research after research now say that can incredibly improve the sustainability of your portfolio. And so other things here, you can actually use a HECM reverse mortgage to help defer Social Security. We can replace that income from 62 to 70 so we can get that 8% deferral credit a year for the rest of our life. That can be a very nice way. We can also use it as really a hedge, because this is a permanent line of credit with a HECM. It can't be canceled, against kind of downside for housing. That once we set it up, it's going to keep growing. It's going to keep growing, unrelated to the value of our house anymore. And so if our house actually maybe 5 years, 6 years into retirement starts declining, our credit line's still growing, we're actually protecting the downside with it. We're diversifying what is otherwise our most illiquid and undiversified asset. And so just my conclusion, it's not the conclusion of the whole webcast, I said I'm going to pass it over to Dan after this, is that home equity needs to, and I stress that again, needs to be part of a comprehensive retirement income plan. It has to be. It's one of the biggest assets that people have. It can dramatically improve their retirement income plan. Now, there's a lot of different strategies out there, and different strategies, I went over 5 or 6, there's actually more than that, but different strategies impact different plans, and so we need to make that decision as we move forward. Which strategy best fits your situation, right? Always individualize it. This is really goal-based planning. And again, you think back, there's that moving target in the wind. However much we can reduce the wind by, the easier it's going to be to plan, and taking into home equity as part of that can help reduce some of those risks. And so that's it from me, and then I want to pass it over to Dan, who can talk more about the specifics of reverse.
Okay, thanks, Jamie. So I was asked to give a quick overview of the reverse mortgage. Let's go to the first slide. When we say reverse mortgage, we're generally referring to the HECM product that Jamie talked about. That stands for Home Equity Conversion Mortgage, and that's the one that's insured by FHA. We're not talking about the unregulated pre-1989 products that created a lot of the misconceptions that still persist today. So when we say reverse mortgage, we're talking about HECMs. In a few minutes when we discuss the reforms, you'll also notice that the reverse mortgage of today is very different from those that were even offered a few years ago. If you want a proper definition, this is a good working definition. The HECM is a federally insured loan product that allows homeowners age 62 and older to access a portion of their equity now in cash or in monthly payments or later from an established line of credit. Now that last phrase is what plays into the financial planning implications. You can get a reverse mortgage at age 62 and not draw any funds. You have an established line of credit that's growing, and that gives you more flexibility in your later years. Okay, what are the primary advantages? Well, everybody really likes the notion that there's no monthly principal and interest mortgage payments required on this loan. And that's great from a cash flow standpoint, but a lot of people miss the hidden secrets of the reverse mortgage. And that's that if you do make payments as if it were a forward mortgage, well, sure, the loan balance declines in the same way, but you get that additional boost to your line of credit. So, yes, one of the primary advantages is that you have flexibility, but each homeowner needs to decide for themselves whether they want to make payments on a reverse mortgage or not. We always want to mention what are the borrower's primary responsibilities. Now, we mentioned they don't have to make a monthly mortgage payment, and that's great. But they do have responsibilities. They need to occupy the home. They need to maintain the home. They need to pay their property charges, including their property tax, homeowners insurance, condo dues if it's a condo, HOA dues if they have them, and flood insurance. Those are things that are very important borrower responsibilities. And of course, those are things they would do anyway as a homeowner. But it is very important with the reverse mortgage that they continue to do those things. All right, let's talk about just one of the most common misconceptions. If I were to walk down the streets of Atlanta where I'm from and ask anybody, why wouldn't you consider getting a reverse mortgage at age 62? The number one answer is always, well, I don't want the bank to own my home. And that's not how the reverse mortgage works. So the number one misconception is that somehow the bank gets your home, and that's not the case. The bank doesn't get your home when you close on the reverse mortgage. They don't get the home when you die. In many cases, the heirs will sell the home, and that's how they receive their inheritance, and that's great. Just make sure that you know that the homeowner gets to retain title and ownership through the life of the loan. That's still the most common misconception. Of course, there's many more. All right, so what do the proceeds potentially impact? Well, it's not a taxable event. Proceeds are not taxed as income, which is great, which opens up all kinds of strategies for managing a client's adjusted gross income. That plays into Jamie's presentation as well, that you can draw from your home equity and is not taxed as income. In fact, the line of credit grows tax-free and can be drawn tax-free. The proceeds also don't adversely affect your basic Social Security and Medicare. In fact, they can enhance those, as Jamie mentioned. You can delay your Social Security. You can actually reduce your Medicare premiums by managing your adjusted gross income. So the proceeds don't adversely affect those two, but we need to be careful because the proceeds may potentially impact supplemental security income or Medicaid. Those are two means-tested programs. I often use the example, if I put $100,000 of her home equity into Mrs. Smith's bank account, she's not going to qualify for supplemental security income or Medicaid. Those are means-tested programs, so we need to be very careful how we handle those. The next question I want to answer is, what is the principal limit? How much do I qualify for? Well, it's different for each borrower, and the principal limit is a figure that represents the maximum amount of funds that can be offered at the time of closing to pay off existing mortgage liens, to pay the closing costs associated with a reverse mortgage. And so the principal limit is a maximum amount, and that amount is generally tied to age, interest rates, and home values. Age or relevant age, interest rates, basically future interest rates, and home value. Now, when I say relevant age, I'm talking about the age of the youngest borrower, co-borrower, or now non-borrowing spouse. That's one of the changes we'll discuss here shortly. It's the youngest borrower, co-borrower, or non-borrowing spouse. All right, let's talk about the non-recourse feature. The non-recourse feature is a great consumer protection that many people don't know about the reverse mortgage. It states that the homeowner and their estate can never owe more than the value of the home at the time it's sold. Well, what that does is it takes a lot of the risk of home ownership, the risk of having a mortgage, in that they can't be upside down or responsible for more than the value of the home. So if property values drop, they're protected. If a client borrows a lot of money over a long period of time and they keep the reverse mortgage a long time, well, they're protected. The non-recourse feature makes sure that the estate cannot owe more than the value of the home at the time it's sold. The last question we want to address is about counseling. Now, counseling was put in place by HUD to have a disinterested third party involved in advising the client. And it's not that they don't trust the reverse mortgage originators or reverse mortgage professionals. It's that the federal government wanted the counselor to discuss other options as well. And Jamie just covered some of those options. So they're going to explain a lot of the things that I just went over in the first 7 bullet points here. They're going to cover that. They're also going to cover other options available to the client. And when they're done, the counselor is going to issue a certificate that's good for 180 days. It expires in 180 days. Now, within that time frame, they need to make sure that they apply for a reverse mortgage if that's their intent, and they need to get an FHA case number assigned, and then they're good to go. All right, so that's just a quick overview of the reverse mortgage. Now I'm going to cover just a little bit more regarding who uses the reverse mortgage, because there's a lot of misconceptions about that. Historically, most people have believed that the reverse mortgage is only for the needs-based borrowers, the desperate, a last-ditch effort to save the home, a last resort loan, and we've heard that many times before. That really wasn't what the program was designed to do. Now, it's effective in many cases at helping our needs-based borrowers, but let's talk about them first. The needs-based borrowers are house-rich, cash-poor, and they need money now. The typical example is somebody who has $300,000 in home equity, but they can't afford their next meal. And we see that from time to time, and the reverse mortgage is an option for them to tap into their home equity. They could sell the home, or they could just get a reverse mortgage, and we can solve many of those problems. But that's a smaller piece of the pie now. You can see that I broke it down into 1, 2, and 3 types of reverse mortgage users. There's actually more than that. You'll also notice that they overlap a little bit. And so I also talk about lifestyle borrowers, so let's discuss them. They're not desperate or needy, but maybe their life could become a lot easier if they just use some of their home equity to pay for some repairs or upgrades to the home. We see cases where they need to renovate the bathroom because of their physical limitations. Maybe they need to update the kitchen. In some cases, they can get by with the home the way it is. Maybe they need a chairlift to get up to a second floor. We talked about that already, and Barbara mentioned some of the things that might be needed as you get older. And so they're not desperate or needy, but we're trying to improve their quality of life. Now, some of them want to travel, some want a new car, and obviously those types of things can improve their quality of their retiring years, but their home is paying for those. And so we call those lifestyle borrowers, and they're quite different from the needs-based borrowers. But let's move on to number 3. financial planning borrowers or financial planning clients. And Jamie speaks very eloquently about the advantages. His organization is doing a lot of research into how this program can be used to strategically use home equity during retirement. And so we see a lot of our financial planning borrowers looking to use their home equity to reduce their tax liability. Well, if draws from home equity are not taxed, then maybe late in the year you can draw some of that to stay under a tax threshold. In fact, doing that also can reduce your Medicare premiums. In some cases, we can delay their Social Security. And Social Security draws are often taken because someone has a very minimal $100 or $200 a month budget shortfall. Well, that can be filled in with a reverse mortgage, and they can delay their Social Security, giving them an 8% annualized increase in their retirement benefits from Social Security each year. And so we'd love to see people use this program to delay Social Security to age 70. That's a great strategy. Some of them are using it as a form of insurance, a standby, or a way of paying for long-term care if needed. Some people don't qualify for long-term care insurance, or maybe they need in-home care at some point down the road. Well, if they get a reverse mortgage early, they can use this as a financial planning tool, as a financial planning borrower, and get the right advice on how they can use this program later in their retirement. All right, those are the three types of reverse mortgage borrowers. Now, I was also asked to discuss the new regulations and consumer safeguards, because we've had a lot of changes to this program over the last 3 years. Since 2013, the reverse mortgage program is almost unrecognizable from the previous generation of reverse mortgages. So for that reason, a lot of people call it the new reverse mortgage. It's totally different. In fact, 2013 was a very big year, and as a reverse mortgage trainer, 2013 was very hectic. And it started with initial disbursement limits. We found that people were using the reverse mortgage as a massive cashed-out refinance leading up to 2010, 2011, 2012. And so the program was changed that unless a homeowner is paying off large loan balances, well, that homeowner might have access to only 60% now within the first year. The other 40% is set aside as a line of credit in most cases, and a growing line of credit to be used in year 2, 3, 4, or sometime later. And so there were changes to initial disbursement limits to make sure people looked at this as a financial planning tool and not as a massive cash-out refinance, which it was not intended to be. Now, in 2013, we also had major changes to the way the insurance program was structured. That's the initial mortgage insurance premium, some people call upfront mortgage insurance premium or MIP. And that was restructured because historically, all homeowners would pay an initial premium of 2% to the federal government as a closing cost. It's generally 2% of their home's value, or $625,500 or less. So it's 2% of that amount, and that could be pretty sizable. But now it's restructured so that low-risk homeowners are only paying 0.5%. Well, that's a significant reduction for people who are using it for financial planning purposes. Someone whose home is paid off, and maybe they only need a small amount now and leave the rest in the line of credit for later. Well, now they're paying a much reduced mortgage insurance premium up front to the federal government. Now they're going to pay either 0.5 or 2.5% to FHA as a result of their initial disbursement. All right, let's move on to 2014. 2014 saw a major change to assist non-borrowing spouses. What's a non-borrowing spouse? Well, if your spouse is not 62 at the time of closing, they're not going to be a party to the reverse mortgage. This program was not designed for those under 62. So if a borrower is married to someone, say, age 55, 58, 60, they're not going to be on the reverse mortgage, and they're not going to be on title. So as a result, historically, that posed a problem because reverse mortgages are due and payable at the time the last borrower passes away. So that problem was solved in 2014, and then some changes in 2015 to clarify that. But now non-borrowing spouses that are married at the time of application and reside and continue to reside in the home may be eligible to defer the due and payable status of the loan until they pass away. Well, that's great, that a widow or widower that was under 62 at the time of closing, now they get to stay in the home. And so there are options for them to stay in the home as a non-borrowing spouse. So that was a major change in 2014. Now, last year, we had a big change called financial assessment. And the reason for financial assessment is because we want to make sure this is a sustainable solution for every homeowner. If at all possible, we need to make sure it's a sustainable solution for the homeowner. And so as a result, we now have to examine everyone's credit. We have to look at their property charge history. We need to examine their residual income to make sure that this is sustainable. And the results of financial assessment tests by an underwriter is not to give a thumbs up or a thumbs down, yes, you qualify, or no, you don't. The goal of financial assessment was to determine if we should set aside a portion of their principal limit to pay their taxes and insurance, property charges, just to make sure they don't get into trouble. So you can see that there's a lot of regulations and consumer protections that have taken place over the last few years. Again, this program is almost unrecognizable from the loans from 2008, 2009, 2010. And so hopefully this gives you kind of an overview. Most reverse mortgage professionals are going to cover a lot of this material in maybe 1 to 2 hours with the client. Hopefully 15 minutes gives you a quick overview. I'm going to go ahead and turn it back over for questions.
All right. Thank you very much, everyone, for a great presentation. Lots of great information from you all today, so thank you very much for that. As you can see from the slide up on your screen, it is time for the Q&A portion of today's webinar. So please text us in those questions, and we will present them to our presenters here. The first question here, if someone just wants to grab this one, can the maximum principal change during the term of the reverse mortgage, for example, home values dropping?
Okay, yes, I'll address that one. In fact, that's the difference between the principal limit and the current principal limit. So when they see their mortgage statement, they will actually see what's called the current principal limit. And the current principal limit increases over time. Now, if the property values decline, no. It's actually set at the time of closing. And so FHA takes a lot of risk there. And that's why there's mortgage insurance, because they're taking on risk. If property values decline, FHA could be on the hook for some deficiency. So, but no, the principal limit is not going to go down. In fact, the current principal limit goes up over time. And there's multiple reasons for that. The way they structured this program, they really didn't want older homeowners to refinance consistently as their property value goes up. They're a year older, a couple years older, and they refinance to get more money, because in this program, older homeowners qualify for more money. And so the way this is structured actually works very nicely as a disincentive to refinance. Now, there are times you will do what's called a HECM-to-HECM refinance, but we need to make sure that there's a bona fide advantage for the client. But in most cases, yeah, the current principal limit's going to go up. It allows them to borrow more money, and that's really what increases the line of credit as well. So good question.
Right. Next question here. Is this an option for individuals who have not finished paying off their mortgage? What happens if the individual owes property taxes?
Okay, that's a good question. The vast majority of reverse mortgage borrowers are paying off something. Now, if they're delinquent on their property taxes, that's going to show up during the financial assessment review. And there are considerations for that. Of course, we'd love to be able to set aside some of their principal limit to pay those charges since they've been delinquent before. That's an indication that maybe we need to set aside some funds to make sure that doesn't happen again. But the vast majority of reverse mortgage borrowers are paying off significant first mortgages or second mortgages. One caveat to that is we cannot pay off recently secured liens, basically a lien that's been established within the last 12 months. And so there is some seasoning guidelines now that we cannot pay off those if they've been obtained within the last 12 months. Another good question.
Right. The next question here, if someone does a reverse mortgage and does not put it in a bank account, does just taking this reverse mortgage prevent them from programs such as Medicaid?
Okay. It's an interesting question. We always want to make sure as reverse mortgage professionals that we have the borrower check with their benefits administrator. before getting a reverse mortgage just to make sure. Now, Medicaid is run by the states, and so there are state guidelines regarding that. And I won't go into that specifically because it could be different in your situation, but just simply getting the reverse mortgage should not be a problem. We want to make sure that they don't put a significant amount in their bank account to disqualify them from those programs. So that's probably something that the client needs to check with their benefits administrator just to make sure.
Okay, next question here. What is the FHA benefit for offering reverse mortgage?
Okay, well, it's good for the housing industry. It keeps more people in their home. It's really designed to be a stabilizing force for retirement. And so you think of your pillars of retirement income were historically Social Security, retirement and pensions, and all three of those have issues. Social Security may not be enough to supply their needs through their retirement years. Most people are not getting pensions anymore. So that's a problem, and we know that baby boomers have a disproportionate amount of their wealth tied up in real estate, not in retirement savings. And as Jamie showed on his graph, it's a 2-to-1 ratio. And so really this was another form during the Reagan administration to allow people to retire, especially the baby boomers as they saw them coming up in age, allow them another stable form of retirement income. I hope that answers the question. That was really the benefit to the government and society in general is simply it's good for the housing industry, it's good for our older homeowners, it's another form of retirement income and hopefully stabilizes that.
Okay, Barbara, you were talking earlier about people living longer, changes in the healthcare system, et cetera. What might we expect to see with the development of reverse mortgages in the next several years as the baby boomers continue to age out into retirement age and beyond from there? We're already seeing those numbers growing, of course, but as we all know, those numbers are just going to keep going up in the next 10, 15, 20 years here. So what might happen on that front if you could just take a look into the crystal ball for us?
Well, if I could predict the future, I would certainly be doing something else for a living, if I could predict it with certainty. But, I think advances in life expectancy, I think are going to inch up. This is me personally. I don't think we're going to see major breakthroughs unless there's something done on a molecular level to increase life expectancy. But what my colleagues in the reverse industry are telling me is that they're starting to see the average age of a reverse borrower going down. Again, in the past, as Dan and Jamie were talking about, the borrower tended to be, the house rich, cash poor. We are starting to see people using their home, again, as another strategic asset, as a way to help plan for the costs of retirement. So I think we're only going to see this program grow and grow smartly over the next few years.
Okay. Can you just quickly take us a walk through what the process would be if a homeowner needed to leave home to go into a CCRC, for example, something like that? What would happen in a case like that?
Are you talking specifically with a reverse mortgage? What would happen to the reverse mortgage?
I believe so, yeah.
Okay. Well, leaving the home would be a maturity event. Generally, if you need to occupy the home or that needs to be your primary residence for 183 days or more in a calendar year. So obviously leaving the home, going into a nursing home, that would be a maturity event. And generally, the estate would sell the home, or it can, of course, be refinanced. There are multiple ways they can do that. But, yes, leaving the home would actually be a maturity event. So then the loan would have to be satisfied. And generally it's done by selling the home.
Okay, and can you talk about real quick what happens in the event of a drop in the home equity? How does that affect what we've been talking about here?
A drop in the home equity. You mean they have borrowed more money, their loan balance goes up, and the difference between their loan balance and their home's value, of course, would be their equity position. that doesn't necessarily affect their line of credit growth. And so when you, at age 62, establish a reverse mortgage, it is a form of insurance against home value declines. You know, we've seen over the last several years, obviously, a roller coaster with home values. And, well, those who got a reverse mortgage before the topsy-turvy 2007 to 2012 time period, they saw their line of credit continue to grow regardless of home values. So it's a way of hedging. You know, you've basically created a form of insurance against home value declines or home equity reductions. So it's a form of insurance in that case.
All right, good to know. Well, we have reached the end of our hour here, presenters, and we are unfortunately out of time. But I want to thank you for being here with us today. Jenny Warwa, Barbara Howard, Jamie Hopkins, and Dan Hultquist. Thank you very much for being here. We really appreciate it.
Thank you so much.
Thank you.